Hello and welcome to Cima F2 Financial Management, Chapter 5, IS 39 Financial Instruments. I think many of us are aware that when we hear financial instruments, we have a bit of a cringe, but they're not that challenging. I mean, it's true that these are very controversial standards and they are changing, and we're slowly moving from the IS 32 and 39 regime to an IFRS 9 regime, but that does not mean you cannot at least for the purpose of Cima F2, get a grasp of this area. When people hear financial instruments, they usually associate them with derivatives, sophisticated instruments. That's true, that's part of what the standards refer to, but also we have primary financial instruments such as receivable, payables, cash that you are encountering on a more regular basis and you're more familiar with. So financial instruments is definitely an area to grasp and sufficient knowledge to gather for passing your exam. So we recommend in this chapter the four, key, few areas that you would like to cover, and we'll start with the four different classifications of all financial instruments. We'll look together at that. Then you need to have a good understanding of the difference between fair value and amortized cost, which are the two valuation methods of your various categories of financial instruments we'll touch upon. Then of course the possible ways in which any gain or loss may be reported to the financial statements, or in other words, when do you report that. And if you're super excited about the topic, it is examinable for a few marks to have an understanding of hedging. So we'll present the two types of hedging. So let's hit the road and see how many types of financial instruments we should know. We have four categories, we said. We have the first category, held to maturity financial assets, a second category, which is familiar, loans and receivables, and we'll go through various points on each one of them. Then you have financial assets or liabilities held at fair value through profit or loss, and then you have available for sale financial assets. So let's take the first one, held to maturity financial assets. I think it's very explicit. The name of it are financial assets that are held, or the company has the intention to hold for a long time to their maturity date. So you must show that that intention. A very good example you use in our notes here in Express Notes is that the corporate bonds, for instance, are a good example. You issue corporate bonds, or you buy government bonds, and you hold on to them till their maturity. So you're not holding on to them to sell them in the short term for speculative reason. You're just holding on to them for a longer term till maturity date. What are we recording that bond at? Let's say you're gonna use as an initial recognition value the cost paid. And remember, the transaction cost can be included. So it's debit financial asset at cost, credit cash, let's say. What happens at the end of each year with this bond? Well, you'll have to value it at what is called amortized cost. This is very important. Sure, it's less an impairment that instrument may suffer. So keep thinking of a bond. Think you maybe acquired the government bond or issued your own bond, and this amortized cost is created by the initial value, so this value here, initial value, or of course from a period to another will be the brought down figure, to which you are capitalizing at the original discount rate when investment was purchased, the interest rate, so plus accrued interest rate, which is pretty much like an internal rate of return, less any interest already paid, if any interest is paid. Now, if we want to look at the other two categories, because loans and receivables are very similar to held to maturity, so they are put in parallel for you to easily contrast the slight differences. Let's have a quick look at the other two categories. Financial assets or liabilities held at fair value this time, so not amortized cost through profit and loss. So imagine here you'll have anything that can be included, categorized at its initial recognition, such as securities held for trading. So this time you're not holding to maturity the financial asset, you are holding it for trading purposes. And what happens if we keep this category and they go a bit down? Initial recognized value is cash paid to acquire, but what happens to transaction costs are immediately written off against the profit or loss. And the year-end valuation is not amortized cost anymore, it's the fair value. What is fair value? It's a sort of market value, it's the best achievable market price, and you're not deducting anticipated selling costs through it. Now, in terms of, again, any gains or losses, that's for the previous two categories as well. You're gonna hit the profit or loss immediately with them. So fair value is fluctuating. You will have these gains or losses that will hit your statement of comprehensive income, and that will certainly create to a degree of volatility, but it's about transparency and showing the risk to the stakeholders who analyze financial statements. And the final category, available for sales financial assets. You will love this category because it's everything but the previous categories. So we're saying here it's a catch-all category, and here you could include, for instance, shares, but they're not for trading like in the previous category. They are not held to maturity like in the very first category, but they're sort of intermediate term. You're not very sure you're going to sell them or not. So what happens next with initial recognized value? Again, transaction costs are added to initial value of investment. So this is a slight difference from our previous category, where transaction costs, you write them off immediately for your financial assets or liabilities held at fair values through profit and loss. So make sure you read all the details here, but in terms of big picture, again, this is a second category, use fair value like the final category we mentioned. And gains or losses, this time again it's slightly different. You go in a P&L subsequently, but initially you get the gain or loss in equity. This way you sort of avoid the volatility you create for the financial assets that are kept at fair value through profit and loss. And because remember, you don't know exactly what to do with it, it's not held to maturity, but not even for immediate trading, then you can argue, I'll hold on to equity because I'll move it in the P&L when I'm decided I'm gonna dispose of. So it becomes more like a trading financial asset. Maybe I will point out to you as well about a little bit about hedging. And the key thing with hedging is that there are two types of hedging. Before we say a few words about each, hedging occurs when a company is willing to protect itself, and you could do that in many ways, using derivatives, but also primary instruments against foreign exchange fluctuations or even interest rate fluctuations. For the purpose of the exam, we are looking at how we want to basically exercise some hedging, and we'll have here fair value hedge and cash flow hedge. Now, the fair value hedge is when you're trying to protect yourself as a company against a foreign exchange change in value of let's say a receivable or payable. So if you're waiting for a foreign currency receivable to be cashed, what you can do is to have a matching loan in the very same currency. So arguably, whatever happens on that particular currency, whether you win on the receivable, on the payable to the loan, you will lose and you net it off. So you're obviously not getting the benefit of foreign exchange moving in your favor, but also you're not getting the loss. You're hedging yourself, and your core business is not foreign exchange speculations. Therefore, all you need is to be protected rather than make the most of the wins, the speculative wins, because the uncovered or unhedged risks of foreign exchange could take you to a very weak position as a business. And you know, there were cases like Bearings in Singapore quite a while, long time ago, where if you play with financial instruments and you don't use them for hedging but for other purposes, you can be in big trouble. So the fair value hedge is when you try to protect the fair value of one of your receivable or payables, let's say. What about cash flow hedge? A cash flow hedge is when you try to protect the fluctuations your cash flows may have. So again, let's say you have here an example: an entity may structure its business plan around buying a ship from a foreign shipbuilder. So obviously what you'll have in the future is a payable towards the shipbuilder in a foreign currency. Although you have no obligation, you are doing a business plan, and what you can do to protect against this particular potential cash flows volatilities due to foreign exchange, and in order to make sure the purchase is still affordable, the entity should hedge the foreign currency exposure, for instance buying a foreign currency forward contract. And we'll end up on this note explaining what forward contract is when you enter with a bank in an arrangement whereby you say, I'm going to buy now, I'm going to contract now a certain amount of foreign currency at a frozen exchange rate, and I will literally get it at an X point in time. What's the benefit of that? Well, as we said, the intention of that exercise is of the forward currency foreign currency agreement is to have certainty. So even if the foreign exchange may move in your favor, you're not going to benefit of that. Nevertheless, you are secured and you can put settled cash flows in your budget based on this agreement you have with the bank. Okay, this being said, that's your financial instruments highlights. Please don't panic like many people feel about this topic. It is quite exciting to have basic knowledge of it. Not everything is complex, and to the level we touched upon in this chapter is a very, very useful base to start applying it in the few mark parts of your questions for the exam. Until then, best of luck with preparations, and hopefully we'll be in touch with next videos. Good luck with your study.